Following on from the previous episode where I introduced the 5 indicator lines of Ichimoku, this time I focus on the 2 that are designed to provide the entry and exit signals. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. I explained previously how the Ichimoku indicator is designed to provide multiple types of information about price action. One way of describing this is to say that it's an all-in-one indicator. But in today's episode, I concentrate on what are called the Tenkan-Sen line and the Kijun-Sen line. Specifically, these usually have the task of providing entry and exit signals. Let's take a look. All of the indicator analysis that I'm going to be looking at is part of the Spotlight on Indicators video series. And in this series, I'll be using a methodology to rigorously assess the ability of different indicators to help identify a trading edge. Now, at the moment for Ichimoku, we're right at this initial stage, which is the initial indicator research. So, to give Ichimoku its full name, it's Ichimoku Kinko, and it was originally devised back in 1968 for the Japanese financial markets. And in the Japanese language, Ichimoku means glance or one look, and that's very appropriate for this indicator. Because, as I said, it's designed to provide multiple aspects of the asset's price action into this single indicator. So things like the magnitude of the momentum, the directional trend, support and resistance, and all this combined with entry and exit signals. And last time I explained that one of the reasons this has been on my to-do list to investigate is because it potentially provides a solution to the problem of matching the parameters of multiple indicators as part of a combined strategy. And so ultimately, my objective here is to identify if the Ichimoku indicator does genuinely help to identify real trading edges to in turn produce a profitable and robust trading strategy. So all of these different aspects, the momentum, the trend, support, resistance, and so on, are all interpreted from 5 key lines within the Ichimoku indicator. And we covered these briefly last time. But in this episode, I'm going to concentrate on the Tenkan-Sen and the Kijun-Sen. Now, the first of these, Tenkan-Sen, can be translated as conversion line, and the Kijun-Sen is the reference line or the baseline. And their purpose in this indicator is to provide potential entry and exit points. And in many respects, these are used in a similar way to moving average crossovers. But it's important to note that they are not moving averages, even though the principle of their interpretation is the same. But I'm going to leave the underlying calculation of these for the next episode where we'll look at that in more detail. But in this episode, I want to concentrate more on the principles behind using these 2 lines. So here we have an example of price action with the Ichimoku indicator overlaid. And I've purposely dulled out the Ichimoku cloud and the Chiku span that you see in blue. Because today we're only going to be focusing on this yellow line, which is the Tenkan-Sen, and the light blue line, which is the Kijun-Sen. And the first thing to note here is that the Tenkan-Sen is more responsive to price action than the Kijun-Sen. In other words, it follows the price action more closely. So just expanding the analogy of moving averages, you could consider that the Tenkan-Sen is analogous to a fast moving average, whereas the Kijun-Sen would be analogous to a slow moving average. And it's the points that these two lines cross over that gives us an indication of when the momentum in the price action is changing direction. But we can't just rely on this alone because we'd get far too many whipsaws to produce anything close to a robust trading strategy. And so let me show you an example of why that's the case. If we concentrate on the left-hand side of the price action here, where price is in a trading range and isn't going anywhere quickly, these are all of the points at which the two lines cross over. And if you acted on each of these signals, this would certainly result in a loss-making strategy. And it's the other components of the Ichimoku indicator that will mean we're not allowed to take these trades. And that's because Ichimoku is primarily intended for trending price action, such as this that we see in the next section, where there's clear, strong upside momentum. Now what you'll notice here is that although the two lines do occasionally cross, the frequency of that is much lower. And when it does cross, it only crosses for a short period of time. And then towards the right-hand side of the chart, we seem to enter a downside momentum phase. But again, apart from the crossover that happens right at the top, we don't see any more crossovers then until the end of the chart. Now I will, of course, be covering the Ichimoku cloud and the Chiku span line and talking about the rules that need to be enacted in order to sometimes allow a crossover of the Tenkan-Sen and Kijun-Sen, but at other times to disallow those trade actions. But that's all to come in future episodes. But the very basic principle of the rules for these two lines is that when the faster Tenkan-Sen line, which is shown in yellow here, crosses from below to above the Kijun-Sen, that indicates that momentum is switching direction upwards and therefore indicates a potential long trade. And then when that yellow line passes below the blue Kijun-Sen line, that indicates that momentum is turning downwards and therefore is an indication to close long trades or open short trades. Now, I just want to remind everyone that you can actually request for me to perform some analysis and research on an indicator as part of this video series. But as I said last time, please do provide a detailed reason of why you consider the indicator is worthy of investigation. I'll then consider all of the requests and make a decision about which indicators will feature later on in the series. Okay, so next time we're going to get into more detail around the calculations that sit behind the Tenkan-Sen and the Kijun-Sen, and also look at the rationale and the reasoning for those, because with that full understanding, it will mean that we're much more able to put this indicator to good use. And then following this in episode 4, I'm going to turn my attention to one of the other aspects of the indicator, which is the Chiku span. And this is what tells us the market sentiment in terms of the trend direction and the momentum of price action. Okay, so that's all we've got time for this episode. Please do remember to give me a like if you've got value today. But now, until next time, trade safe.